is going on with this economy. And in the last, I guess, the beginning of this year, we have been seeing the market fluctuate, and mostly it's been down, and we've lost anywhere between 16 to 1800 points. What is your take on what has happened since the beginning of this year?
Well, I think reality has set in because, since 2009, we had, this reflation of asset prices where, there was some recoveries in some markets, like China had big stimulus programs. They built a lot of infrastructure projects on central planning, and a lot of the commodity markets did well because of Chinese central planning. Many decades of demand was pulled forward, but there was a lot of evidence, Dave, since 2009 that there wasn't a real recovery in a lot of different other countries, a lot of different industries and things like that. Now, obviously in the US, we had the shale boom. Since 2008, that really took off. That created an enormous amount of high-paying full-time jobs in Texas and Oklahoma and North Dakota and things like that. And that was really a large portion of the of the net jobs, the high-paying full-time net jobs, minus all the jobs that were lost that were created.
Hmm.
And now with this oil bust, that's been in reverse. So basically, I think the reason we're starting to see more volatility come back is people are starting to re-examine things. They're looking at the emerging markets and they're saying, you know what, the emerging markets, a lot of these countries, whether it's Brazil or stuff, they're basically in depressions. And these are not deflationary depressions, although the Keynesians will call them deflationary depressions, but the currencies in these countries, the commodity currencies, whether it's Canada, Australia, their currencies are down a lot. So yes, economic activity in these countries are down, because these countries were reliant on a lot of commodity businesses, but the purchasing power of their money has been inflated. They've lost purchasing power of their money, especially in countries like Brazil and things like that. So you're seeing a situation now where the fundamentals of a lot of these companies, the larger companies, are slowing down. They're closing stores. Their revenues are getting worse. They're missing earnings. Their profit margins are down. Their profit margins cannot, routinely expand all the time. Normally, they're cyclical if you read a lot of work of value investors, and you're seeing the technicals. So you're seeing a kind of a perfect storm for at least a sizable stock market correction, maybe even a crash in the near future. And, a lot of it has to do, like I said, with the emerging markets and commodity currency countries, and also, the oil market. And those things are large, and people are starting to worry. And the question that they're bringing up is, that we're hearing this on CNBC and Bloomberg, is that the U.S. economy they're claiming the U.S. economy is still doing well, but how can that be so when the global economy is so interconnected and so many U.S. corporations are reliant, on foreign businesses and things like that? So it just doesn't make any sense. And I guess, from 2009 up until most of 2015, a lot of people just chased the trend, and the asset markets were going up, so that was the trend. And people like, well, maybe the real economy wasn't doing so good, but the asset prices were going up, so I'm going to make money trading the markets going up. But that seems to have reversed, and now we're seeing volatility on the downside.
Yeah, and we still hear the corporate media saying that everything is fine. It's slowing a little bit, but we'll get an improvement. But we look at companies like IBM, Caterpillar. I mean, we're seeing sales way down, revenue way down, and they sell globally here, and the entire global market right now is really falling apart in front of our eyes. And it's very strange that the Fed in December decided to raise interest rates. Everyone thought, they weren't going to do it. It makes no sense. We know the unemployment numbers are manipulated. Why are they doing this into a weak economy? Of course, everyone was telling us we were in a strong economy. What is your take on why the Fed decided to raise these interest rates in December?
Well, the lie that the mainstream media and the Federal Reserve have been telling people, like you said, is that, the economy is recovering, the economy is strong, so we can go ahead and start trying to raise rates. And, they've talked also about doing another 4 additional interest rate increases, which I don't think they're going to be able to do. I think if they, in terms of probability, if they do try another 1 or 2 interest rate increases, I think something in the real economy or the asset markets is going to break. And, we're already seeing evidence of very large cracks. I mean, like a real break, like maybe subprime housing type of break, because the oil market is way larger than subprime housing. And there's going to be a lot of bankruptcies in the oil market now. And then also emerging markets. A lot of these guys borrowed, they leveraged their economy to China. They borrowed in US dollars. and their currencies were strong, and now they can't pay back the debt denominated in dollars. But I think the real reason that the Fed did raise rates, and I've spoken with a bunch of different people on this, listening to their theories, inflationists, deflationists, things like that. I think one of the main reasons was the Fed's credibility. Because, these guys, these Keynesian economists, these Keynesian central planners, they're more like politicians, Dave. So they care about the perception, how people think of them. They don't want to be caught as liars. They don't want to be that. So if they said that they promised one rate increase, oh, look, we did one rate increase, right? And now, the economy is getting worse. Oh, now we're wrong. We're data dependent. We tried a rate increase. It didn't work. Now that they can pretend that they didn't lose as much credibility. But I think it's very obvious that, any little credibility that they did have left, they're losing it very rapidly. With people like you and me, people who listen to this podcast, they've already lost their credibility or they didn't have any at all. But, the people on Wall Street who manage billions of dollars, they're becoming very skeptical of the Fed. And I think there's probably one other reason why the Federal Reserve raised interest rates. And this is an interesting theory. I heard it from my friend Lewis over at Small Gold, SMAUL, GLD. He worked on Wall Street for a while, and he's a gold and silver guy. But he actually thinks because a lot of the emerging markets, China, Russia, a lot of these countries are dumping their treasuries because, they have to raise cash. They have to protect themselves and their own economies to survive. So he thinks they might have tried one token interest rate increase to try to attract any other buyer they could for treasuries just to buy themselves another couple months to prevent like a big spike in the bond market or a potential bond market event.
Now, with all these companies dropping treasuries, who do you think is picking up the treasuries at this point?
That's really the $64,000 question. I would say it's maybe currency swap deals from Japan. So Japan and maybe Europe and some of these other countries that the U.S. they're basically protectorate countries of the U.S. because the U.S. military is in charge of, their defense. So the U.S., like the Romans used to do in the past, and the British did it too, when there's a large empire, they're expected to pay tribute and also to do things like propping up the status quo in financial markets. What I would also say is, the Exchange Stabilization Fund. I mean, there's evidence it was created in, I think, the Securities and Exchange Act of 1934, or around 1933, 1934, around, when FDR announced that he was, it's not really confiscating gold because people did get cash for it, but he basically took the gold and forced you to take dollars for it, and then he devalued the dollar against gold. So, whether it's the Plunge Protection Team or the Working Group on Financial Markets, there's a couple of those groups. One of them is just academics. The other is the Exchange Stabilization Fund out of the Treasury. Maybe it's a combination of things. Maybe it's the Bank of International Settlements. These things, Dave, are intentionally covert and intentionally non-transparent. So, once in a while we hear in the press releases, normally it's not from Bloomberg. Normally we have to hear press releases from a foreign news website about a large currency swap deal. There was to give you an example of this, there was a large currency swap deal that China, and I think it was in October or November, China announced they were working on a very large currency swap deal with Venezuela because Venezuela was on the total verge of bankruptcy then, and they needed to buy, a couple months, and China was negotiating with them for, to give them kind of a bailout. But all the details, and the mainstream press didn't even cover any of this. So
yeah, they don't want you to know anything about it, what's going on. You also mentioned something about oil, that it could be bigger than the subprime. And we know that banks have been speculating in the energy markets, and we see that globally we've lost about, 250,000 jobs in the energy sector. Do you see the banks being open to some type of problems in this area? Do you think it's bigger than the subprime?
It's a lot bigger than the subprime. It's global. All the major banks in almost every country all have oil exposure. So you have a situation. The oil market is the world's largest market, and it's productive. We can't run any type of modern economy as of right now without oil, because it's the most energy dense in terms of transportation fuels. It's the best transportation fuel we have right now. Although, there's other technologies out there that intellectual property and things like that have blocked. And, maybe in the future, in a couple decades from now, maybe we will be less dependent on oil. But, the oil market is the main market right now. So there's enormous exposure to that. And no one expected, really no banker, no oil company expected the oil price to go to this level and stay down at these levels for this long. And, we're basically still falling. And it's just shocking, and we're looking at a situation where a lot of OPEC, they really shouldn't be increasing production, and they would only lose a little bit of market share, but they're still, I guess they're so bankrupt themselves, a lot of them, or they're so desperate to pay, their social programs or their bills. They're so desperate for any type of cash at all, they're willing to give away this oil at way below cost. So you have a situation where Iran is coming back. They're going to bring more oil production back online. The Saudis haven't cut production. This, Dave, I was speaking with one of my oil expert friends last week, and he said basically over the last 2 years, this is counting 2015 and 2016, if the oil price doesn't go back up, OPEC's going to lose over $1 trillion giving away the oil price for cheap. So there's going to be huge ramifications for this. There's derivatives tied to oil. There's enormous amounts of loans tied to oil. There's a lot and the scary part about this, and Zero Hedge ran a story, and you could link this to your listeners later, is that a lot of the banks haven't carried any loan loss reserves for any of the oil bust yet. So what the banks are doing, the American banks, I can't speak for the rest of the banks yet. I haven't looked at foreign banks for their oil exposure. Although, Deutsche Bank has huge exposure, I believe, to Glencore. I think it's Deutsche Bank. There may be another Swiss bank, too, with Glencore. But anyway, though, a lot of these American banks, they didn't keep any cash in reserve for any potential loss on the oil. So it's looking like, there's going to be another bailout, another potential large bailout round. We've seen whispers. Zero Hedge and the Fed are having a Twitter war right now about that. You heard about that breaking story where Zero Hedge reported last week that the Dallas Federal Reserve Bank told the banks in the United States not to call in the bad loans on the oil market or start marking the oil loans down because it'll create contagion and a panic again.
Right, to basically lie and keep the...
Well, I don't know if it's $49 to $59 per barrel, but they're not marking the thing is the value of the loan then. So then the value of the loan, whereas the loan might only be, pricing in bankruptcy risk, the loan might only be worth right now, 20 cents on the dollar. If they loaned out, like, let's say a bank loaned out $1 billion loan to a medium-sized shale oil producer, and they loaned out $1 billion, and the shale oil producer, their equity's down, and, the shale oil producer says they're cash flow positive at 50, but we're below $30 or around $30 on the oil price. It's been fluctuating a little today. So, they would have to mark that to market, and the bond market is saying, that oil loan is not worth 100 cents on the dollar. That oil loan is really worth, 20 to 30 cents, and bankruptcy risk is high due to the balance sheet of the company. And the Federal Reserve may or may not, I don't know how soon we're going to find out the truth about this, if ever, until maybe, a potential collapse. But, the Federal Reserve may or may not have told the bank that, don't tell the market the truth about the value of your oil loan portfolio. You'll create a panic. You'll go bankrupt. The counterparties for your bank will go bankrupt, so on and so forth. So it's just very frustrating, Dave, that, there's so much lack of transparency right now. Obviously, I think a lot of these oil producers, if they do start going, they should have gone bankrupt already, especially the shale producers in the U.S. But it seems, there's an implicit guarantee or bailout from the Federal Reserve or the Wall Street banks that, they're in the hole billions of dollars. And it seems, here's another, you're in the hole a couple billion. Oh, here's another 50 million or 100 million. We're going to give you another, 4 or 5 months. The oil price rebounds, you'll survive. So they're basically, the oil companies, which are basically insolvent, a lot of them, they're being given a little bit of extra debt to buy themselves, another couple months, because the banks, I guess, are hoping that the oil market will turn around. So it's going to end very badly if the oil price doesn't go back up.
Do you see the oil market turning around anytime soon with Iran coming online now?
If the shale producers do go bankrupt, this market is not acting rationally right now at all. I mean, there is a slight oversupply, depending upon which estimates you look at. The oil market is, about 1.5 to 2 million barrels per day oversupply. Maybe it's a little bit more than that at this point. Iran hasn't fully brought back the online production, but Russia also announced that they may be doing a little bit of cuts. There's a story on that on Zero Hedge, that there may be some cuts for that. So it's it's a question, and the main oversupply, Dave, for our listeners out there is the 4 million plus barrels per day of oil production the shale producers have brought on. And these are very high cost wells. They have been able to cut back on costs on these things. So costs have fallen somewhat, but they're still, all the shale oil producers, almost all of them, are telling Wall Street. So there was a Goldman Sachs oil conference a couple weeks ago, and the shale oil producers wouldn't tell Wall Street what their current costs are, and they were telling, oh, we're cash flow positive, we can generate free cash flow of $50 oil, but we're nowhere near $50 oil. So basically, these guys are going around trying to pretend they're not insolvent and trying to raise, a little bit of extra money just to buy themselves another couple months, hoping the oil price rebounds. The analogy my oil friend that I talked to recently said was, the analogy about, oh, you don't have to be faster than the bear. You only have to be faster than the guy next to you trying to outrun the bear. So basically all these guys are either borderline insolvent or insolvent already, and they're just trying to be less insolvent than the guys next to them so they survive when the oil price goes back up. But yeah, I think eventually, long term, this is unsustainable for the oil market right now. 90% of all the oil supply, about 90%, is uneconomic right now. It's very uneconomic. So this is clearly unsustainable. We have a situation where OPEC, I basically think I think it's a tug war between OPEC on one side and the shale and the Federal Reserve backing and the Wall Street banks backing the shale oil producers on the other. So it's a crazy market right now in oil.
Yeah, it reminds me of the subprime where they kept on telling us everything's fine, everything's contained, don't worry about it. And it seems like we're heading down the same exact path once again.
Exactly, and it's even larger because oil, for a lot of these economies, what most your listeners may not understand is for a lot of these countries, the commodity currencies, the developing countries, some of their largest companies and industries are their oil and commodities industries. So you have a situation where not only are their commodity companies doing very badly, and there's probably going to be a bankruptcy with Petrobras, the large Brazilian company. It's mired in corruption scandals, and they borrowed way too much debt in U.S. dollars and things like that. And even the Brazilian president is being brought up on impeachment charges for misappropriation of funds and things. So, Brazil is in a lot of trouble financially with their companies and their government. But it's the oil market. A lot of these developing countries are in such financial trouble because, like I said earlier in the interview, they leverage their economy to China and other growth stories. And, when the commodity prices were high and their currencies were strong relative to the dollar, it worked. So for about 10 years, they were able to borrow a lot of debt and run a pretty nice economy, but they used so much debt doing it. It's not just the oil market that's bad, it's the developing countries. So if the oil market stays this low, we're going to have potentially bankruptcies and from developing countries too, like Brazil and things like that. So the oil market could trigger country defaults and things like that down the line. The IMF even says that if oil prices don't rise, Saudi Arabia will blow through all its cash reserves and be bankrupt in 5 years.
Yesterday, I saw that Saudi Arabia is already going to implement capital controls. They're looking at their welfare system, and it looks like Saudi Arabia is not doing as well as they did before because of the lower oil prices. I wanted to move on to precious metals because we're seeing around the globe, the European markets, we're seeing the South American markets here in the United States. Everything's just completely deteriorating in front of our eyes. But gold, yes, it rises a little bit, it falls, but it's been staying steady throughout all of this. Does this make any sense at this point?
Well, what I wrote in the report, and your listeners can go to the Wall Street for Main Street website. That's WLSTFORMAINST.com, and they can download once they sign up for our email list, they can get the report for free. And we talk about this in there with gold. I think the more the regular asset markets fall now, I think the more money will rotate into gold. And we're already starting to see that. We started to see that somewhat in 2015, and it's been accelerating. So I think the more the regular stock market falls, the more people get worried about the bond market and things like that. I think the more money will start to rotate into gold. What a lot of the mainstream Wall Street people did was they had a lot of gold after the 2008 crash, and they held it for a little while, and then they dumped it, 2011, 2012, and they've been shorting it. And now I think they're starting these are not, people like you and me who view that there was no real recovery in the global economy in the United States. But these people are starting to say, you know what, the A lot of the global markets look like they could crash. There's going to be large corrections. This volatility is increasing. I'm going to cash, and I'm also going to gold. But yeah, when we look at the fundamentals in the market, Dave, I mean, the fundamentals of the gold market, they're very strong. I think China, on the Shanghai Gold Exchange, China imported 100, maybe even slightly over 100% of all the global annual gold mining supply. So over 2,500 tons of gold was withdrawn from the Shanghai Gold Exchange in 2015, according to Kuz Jansen, a bullion star. So that's an enormous sum. It's a record. I think other than 2013, maybe it's a record sum.
I wanted to ask you, and this is a type of a prediction here. I mean, from everything that you've been looking at and what's been happening around the world, do you see the economy heading into a deep depression this year?
Well, I said in the report, I think it would be a minor miracle if the stock markets didn't have a major correction or crash before November, before the presidential election. I think they would have to do enormous amounts of, currency swaps and reverse repos, and then they'd have to do a lot of painting the tape with these high frequency trading algorithms. And, they've been able to do that. They've been able to slow the decline of the stock market correction that we're having. Because obviously in 2015, back in August, the technicals really started to break then. The short-term technicals were predicting crash then in August and September, and they managed to slow that down and fix things temporarily on the technical pattern on the charts. But it's a topping process. In terms of like a crash, I mean, it's the exact timing of it. It's just something I wouldn't try to predict the exact timing of it. Especially if you're trying to bet on the crash or things like that. I mean, if you have cash on the sidelines, maybe some in your bank account and some outside the system, you have maybe some Bitcoin, just in case. You have some physical precious metals. Maybe you're accumulating a little bit each month instead of trying to time the market perfectly. You just dollar cost average and buy a little bit of gold and silver every single month. Just in case. I don't think you really care if the markets are gonna exactly when the markets are gonna crash. I think most people who care about the markets are gonna crash. They either still own too many stocks, regular stocks, or they're betting on the markets are gonna crash. So for most of your listeners out there who are just hold gold and silver and cash and maybe a little bit of Bitcoin and things like that, I don't think it really matters the exact timing of stock market crash unless you're trying to time when it's gonna crash.
Since we've been talking about the economy, how does what's happening in the Middle East affect any of this? I mean, does that have any bearing on what's happening in the economy right now? What's happening in Libya, in Lebanon, in Syria, Iran, since we've made the P5+1 deal, and we know that a lot of the oil there is priced using the petrodollar. So does that have any effect on what is happening in the economy here in the United States and around the world?
Well, what I would say is a lot of these OPEC sovereign wealth funds, these guys were making a lot of money with oil at $90 or higher. So they had very large amounts of capital invested in U.S. stocks and things like that. Mm-hmm. What you've seen over the last year, and this is accelerating even further, Dave, is you've seen, Qatar, the Saudis, a lot of these rich sovereign wealth funds, even I think Norway, they've had to start selling their U.S. stocks. So they owned a lot of U.S. stocks. When you combine all the sovereign wealth funds, it was probably well over $1 trillion in total U.S. stock holdings. And they've been selling their U.S. stocks to raise cash because they need the money for their own bills, for their own economy. Obviously the Saudis are fighting kind of Iran. They're fighting a proxy war, I believe, in Yemen. They've been doing other things. The Saudis and Iran no longer get along if they ever did. But, it's in terms of the real economy in the U.S., I mean, obviously the military spending is going to increase. The politicians here in the United States are going to figure out ways to keep increasing the budget. It's just all very frustrating. I think the Middle East for now is somewhat insulated. But, if the oil price goes low enough, we could have a war where maybe one OPEC country tries to take over another, like a real full-out war there. So it's very interesting, all the things that are happening. That's not really my expertise, though. But I just can tell you, though, that these countries, their economies are not doing well at all with the oil price so low. and they're going to react. Maybe they'll justify it and rationalize it, but they're going to do something pretty that the rest of the world will probably view as pretty stupid, in terms of maybe start a war or attack or something like that in the Middle East if the oil price doesn't start to rise. But they are selling a lot of their U.S. stock exposure, and that's putting even more downward pressure on the stock markets, because these guys had lots of share exposure and they had a lot of other ownership of assets in the U.S. markets, and they're dumping them.
Now, for my last question, last time you were on, I asked you how bad it's going to be. Has anything changed since the last time you were on here? When you look at the economy and what's happening, how bad is this crash going to be? Is it going to be equal to 2008, or is it going to be much worse than 2008?
Well, it really depends on what the Federal Reserve decides to do. If they decide to do QE4, obviously, I think things are in the next couple of years are going to be worse than 2008 if this persists. Obviously, there's too many credit. There's lots of debt out there that cannot ever mathematically be paid back. You know, the oil debt was the shale oil debt was really only added since 2008. So, I mean, things have gone in terms of all the extra credit in the system. The governments basically took all the extra debt that the corporations and the banks had made, and, you know, they took it onto their own balance sheets just to buy reflation in the asset markets and buy another few years. So I think things are going to be probably worse than 2008. But the question is then, how fast will things recover? So if the Federal Reserve didn't do another quantitative easing program, you know, and potentially try to drastically inflate things, you know, the markets could eventually clear. We could have a really painful depression for a few years, maybe 5 or something like that. And, you know, the business community could say, you know what, we're going to have to write off all these bad loans, and we're going to start over and things like that. There's proof that free markets work. We had the Great Depression in 1920. It's not talked about in regular mainstream textbooks. As an Austrian school economist, this is something I like bringing awareness about. You know, we had worse unemployment levels in the Great Depression in 1920 than in the 1929 Depression. It was really horrible for 18 months, but yet, you know, there was no bailouts, there was no quantitative easing, and the markets cleared. Now, obviously, things are a lot worse now, and there would be a depression for longer, but, you know, we need wages and prices to fall in this country. The middle class in the United States, Main Street, which is what the people we focus on educating, you know, the mainstream media is talking about this deflation. And yes, you know, there's cheap gasoline and there's going to be cheaper asset prices, it's looking like, until maybe the Federal Reserve comes and prints it. But the people on Main Street, Dave, unfortunately, they're not going to see a lot of beneficial deflation in terms of their purchasing power increases. You know, my bills, when I look at the bills I pay, my healthcare bill is going up every year perpetually, and I'm not getting higher quality goods and services for the pay increase. Rent is going up for a lot of the listeners out there who live in major U.S. cities. You know, food bills are going up. What the restaurants are doing and at the grocery store is they normally keep the price the same, or they raise the price, you know, by 10% or something. But the portion size of the food that you're getting, your cost per unit, is down like 20, 30, 40%. It's down a lot. So we're seeing a situation where any beneficial deflation, which according to the Austrian School of Economics is an increase in the purchasing power of your money, we're not seeing that for the people on Main Street in most cases. So I think, you know, if the Federal Reserve, if these global Keynesian central planners, if they let things go and just crash, and, you know, we would be better off for it 5 or 10 years from now. Obviously, things would be very bad for a while, and people would have to learn to do more with less. People would, you know, not be able to have access to credit markets and things like that. But, you know, if you've been a disciplined saver and you don't use the credit card a lot and things like that, I think people would be okay. But our nanny state, our big brother, all these central planners all over the world, these global bankers, a lot of the politicians who are borderline Marxists or fascists, or, you know, the ideologies are not really that different when it really comes down to it, because I think Marx would have supported fascism. He would have been very happy about what's going on, how it's pervaded the culture. So I just think, you know, we need to cleanse the bust, the crash. I'm an Austrian school economist, is the cure. And they're not allowing the real cure. The Keynesians keep saying, oh, we can't have deflation. Oh, we can't have this. But, you know, that's where Austrians and Keynesians differ, is that the bust, the crash, that would be the cure. It would be very painful. And, we may have really bad civil unrest for a while, but that's what we need. We've had so much, misallocation of capital, malinvestment, and things like that. The economy needs lower wages and lower prices. We cannot have a situation here where all the prices are going up, Dave, and the real wages are not rising. So I don't know how much longer this can go on. Even if they do a quantitative easing 4, I don't know how much longer that could buy them time. But, this is becoming a dystopian. We have a satirical podcast called Welcome to Dystopia. So it just things just become more theater of the absurd every day as far as I'm concerned.
Jason, thank you very much for being on the X22 Report Spotlight. How can people see your work?
Well, we have a YouTube channel, which is wallstreetformainstreet.com. It's all one word, WLSTFORMAINST.com. We have a lot of interviews with a lot of experts up there, although, I do stuff myself. We also have the Welcome to Dystopia show, which is new, where we have our weekly scumbag of the week nominees for crony capitalists and corrupt politicians. Give us a little laugh in this time. It's gallows humor and satirical. And they can go to the main Wall Street for Main Street website. It's spelled the same. And they could get our report, which is a review of 2015, a preview of 2016. There's some stock picks in there. The stock picks are not regular stocks because the regular stock market is not cheap, but there's a lot of alternative investments like gun stocks, and there's gold and silver companies that will survive even lower prices, in our opinion, and things like that. So there's alternative investments out there for people for diversified, because rule number 1, if you read the report, is the rules are going to change. And we're seeing this, whether it's the Federal Reserve telling the banks that, you don't have to write off your loans. The rules are going to change. This is going to be very frustrating for most people. I wish things were different and things were more transparent and easier it was an easier thing to navigate. But this is the new normal that we're in, where there's a lot of lawyers in DC, and there's a lot of corporate lawyers and Wall Street lawyers who are, being told what to do by the people in power, the power that be, and they are going to change the rules on you. So do not think that you have everything fully figured out, because unfortunately you have to expect the unexpected. Now the rules are going to change.
Jason, thank you once again for being on the X22 Report Spotlight.
Welcome.